So before we took the break there, we started to look at some of the things that you need on a VAT invoice. So let us just go and have a peep at some more. When you do a VAT invoice, you have to show the price per unit of the item that you're selling exclusive of VAT. You're supposed to show any discounts or price reductions. You've got to show the breakdown of that by rate. So for example, if you have some items on your invoice that are 23% and some that are 13.5%, you have to show the difference between the two. You have to break those down. Then you've got to show the total of the VAT. You're supposed to show the date on which the goods or services were supplied, and that's basically to make sure that you're invoicing at the right time. And in case of an early payment prior to the completion of the supply, the date on which the payment on account was made, if that date differs from the date of issue of the invoice. So again, if we use our kitchen company example, imagine somebody said, I want to buy that kitchen or that couch or whatever it is, and most places now will insist that you pay in full before they actually order for you. So you would pay for your couch, you would pay for your kitchen sink, whatever it might be, in advance. So what they're saying there to you is that if you get a payment prior to the completion of the supply, then you've got to show what that date was. Again, that goes to the idea of making sure that you're invoicing within 15 days at the end of the month in which the item was, the item or the service was supplied. So let's just have a quick look there and see what a sample invoice might look like. So let's just take this one here, and the important things for us, because we're looking really at the VAT at this point in time, the important thing is that you've got your unit price, you've got which VAT rate those items are at, you've got the net amount, you've got the breakdown of the VAT, you can see here under the arrows, and you can see you've two arrows here with VAT rates, some 23%, some 13.5%, and then you've got the total of that is equal to the total of these two together. Now, this is only a sample layout. Your invoices may look entirely different from this, but if you look at them and look at them in comparison with the list, they'll have a lot of those items there that are on the list. And don't forget, there are a lot of things that are should have and there are a lot of things that are must have. So just be aware that there are certain things that must happen. So for example, on a VAT invoice, you must show the VAT separate from the net amount. Okay, so there's our sample invoice. So if you want then to calculate your VAT liability, so let us say with revenue, you can have every 2 months, every 4 months, you can have annual, or you might have something else agreed with revenue. But if you're trying to calculate your liability, it's basically your VAT charged on sales less the VAT incurred on purchases. That's your VAT liability. So obviously, if the VAT on sales exceeds the VAT on purchases, then you as the trader owe a VAT liability to the revenue commissioners, okay? And that will be a current liability in your books. If the VAT on your purchases exceeds the VAT on sales, then the VAT registered trader is entitled to a refund of VAT, which is a current asset, okay? So your VAT control account could be either a liability, in which case it would be a credit, or it could be an asset, in which case it would be a debit, depending on the levels of VAT in that particular month. So in the first place, you would normally expect that your VAT on sales would be more than your VAT on purchases, but that's not necessarily so, because let's say, for example, if you were a retailer, well, along in October and November, you'd be building up stock for the Christmas trade, but you wouldn't be making those extra Christmas trade sales yet. Also, for example, you might be a VAT registered trader and you might buy a van. And a van could be 40, 50,000. You might buy that van including VAT and you'd be entitled to claim that VAT back on the spot. Okay, so it's not, although you would expect that you would always owe VAT, that's not always the case. And remember, we spoke about those people who are selling zero rated goods and services, and they're able to claim back their VAT all the time. Okay. So there are two ways of calculating your VAT liability. And for any of you who are providing services to other people, this is really, really important. So if you're providing a service to another person, or you're providing a product to another person and getting paid later, so giving that person credit, you really need to listen up to this one. There's the invoice basis, which is the most common basis, and there is the cash receipts basis. Okay, so let's have a little chat about this. Invoice basis is where you account for the VAT when you issue the invoice, and it's based then on the VAT invoice date. Remember what we said, 15 days from the end of the month, at the latest now, 15 days from the end of the month in which you supply the goods or services, you have to account for the VAT on those goods and services, and you have to invoice the person. Okay, so in this case, you issue your invoice and your VAT liability is based on the date that's on that invoice. The date the payment is received from the customer is irrelevant under this basis, and you can't delay accounting for VAT by delaying the issue of an invoice. So it's always, you must account for the VAT by the 15th, i.e. you must invoice by the 15th of the month following the month that you supply the goods or services. Okay. Now, imagine that you give people credit and you're a small business and you cannot carry that VAT bill. So in this case, in the invoice basis, you may have sent your invoice, but you haven't been paid yet. So you might have to send the VAT to revenue when you have not even been paid yet. Okay. So then the other way for you to calculate your VAT liability is on a cash receipts basis. And this is really important for people who give credit and small businesses who wouldn't be able to carry the burden of paying VAT basically in advance of having been paid. So the cash receipts basis, or the money received basis, is basically saying that you are liable for VAT only when you are paid. Now, you still invoice in the same way as before, but the VAT that you will actually be liable for is only the VAT on the sales that you have collected for. Okay. Now, it's very important that if there has been a VAT change, a VAT rate change, that you are applying the VAT rate that was in effect on the date of the invoice, not when the payment was received, because it's possible that you would get paid a year later and there may have been a change of VAT rates. You can't use the cash receipts basis when you have a transaction between connected people, and transactions in respect of land and buildings are excluded from the cash receipts basis. So what's the difference here? In this case, when we go back to our invoice basis, we see that you invoice before the 15th of the month following the supply of the goods or services, and you calculate that invoice in your VAT return whether you have been paid or not. On the cash receipts basis, you're still invoicing in the same way, but you're not including the VAT on that invoice until you are actually paid. Now, as we say, you've got to stick with the VAT rate that was in effect at the date of the invoice. It can't be between connected people, and it can't be with regard to land and buildings. Now, so you might say, well, why would we not do that? Well, let's just have a quick look, because you can't do that automatically. You have to ask revenue, may you be on a cash receipts basis? So it's only allowed when your turnover is below 1.25 million. Okay, so they say once you're over that turnover, you're well able to carry that VAT burden. And that was actually increased. Yes, in fact, it was increased to 2 million in May 2014. Or if you derive 90% or more of your turnover from sales to unregistered people, or if you can only account for VAT on a cash receipts basis by application to the revenue commissioners and with their approval. So it's really important that you don't just go off the reservation there now, guys, and put yourself down as the cash receipts basis. You would have to ask revenue for permission to do that. And you might recall that when we last week did our SAGE, when we were setting up our company, Rachel's Solar Solutions, we could have chosen standard cash, or we could have chosen cash receipts basis. And you remember we said we would mention that. So here we are mentioning that one now. Again, just note that either basis, so whether you're on your invoice basis or your cash receipts basis, you always claim back the VAT on your purchases. Okay, so they are claimed back as you go regardless. It's only on your sales. So if someone hasn't paid you and you're on cash receipts basis, you don't have to pay the VAT to revenue until they have actually paid you. So if you owe revenue commissioners VAT, that's a current liability. If revenue commissioners owe you VAT, that's a current asset. Okay, so that is as much as we need to say about that one for the moment. So now let's have a look at a VAT return. Okay, so this, and I know it's very small, so this is what a VAT 3 looks like. So on your VAT 3, basically you look and you would do this, go through Ross. You would go into Ross and you would go to make a return, you choose VAT, and then you would choose a VAT 3. So you look here at the taxation period, so you would choose. So what did we say? You have 2 monthly, 4 monthly, annual, or if a person is in a constant refund situation, revenue may allow you to do that monthly. Okay, so your tax period, you choose. You would use your little drop down arrow here to choose. You would put in your VAT on sales, your VAT on purchases. You're expected then to say, was there something unusual here? So for example, we have talked about buying a van. If you were to buy a van, you would click on yes, and you would say, I bought a new van, and this is who I bought it from. This was the net, the VAT, and the gross. Then you click calculate, and the return itself tells you then whether you have VAT payable or repayable to you. Down underneath here, then we'll see you've got goods to other EU countries, goods from other EU countries, and if you had registered to buy and sell services to other EU countries, you would have another 2 boxes down underneath here for services to Europe and services from Europe. And then you would click on next, and you would go off and you would make your payment. So that's what a VAT 3 return looks like. Okay, and you would do that typically on whatever period return that you had agreed with revenue, which is one of the most important parts of being able to use a computerized system, is that you don't have to do all this calculation of VAT, which could be some tiny numbers. You know, you could have some very small figures coming in from petty cash or something like that, but the computer will do all of that for you. Last thing that I want to look at before we go on this one is international trade. Okay, when you trade with EU countries, okay, or when you trade with non-EU countries, you've got to understand what the rules are. So first, I want to talk to you about goods. There are 4 different options for VAT with your international trade. So number 1, imagine that we've goods leaving Ireland to an EU country, and that's called an intra-EU supply. Okay, so an intra-community or an intra-EU supply. So this is goods leaving Ireland to the EU. If the customer isn't VAT registered, you charge your normal VAT rate on your invoice. If the customer is VAT registered, you supply an invoice at 0. Okay, provided that that registered person provides their VAT number and that the Irish supplier quotes the customer's number on the invoice that's issued. Okay, so what am I saying to you? If they're not VAT registered and they're in the EU, you charge the usual Irish VAT rate, the very same as you would with any Irish customer. Okay, if they are VAT registered, then you supply them an invoice at a 0 rate, provided that you have their VAT number and that you quote that number on your VAT invoice. Okay, so that's option 1, goods leaving Ireland to the EU. Option 2, a little bit more complicated, coming into Ireland from the EU, okay, and that's called an intra-community or intra-EU acquisition. If the customer is not registered for VAT, the supplier's country rate will be charged. If the supplier is registered for VAT, the supplier charges 0 and the Irish customer then self-accounts for VAT. And what does that mean? It means that the invoice from the EU supplier will show the net amount with 0 VAT. The Irish company includes the net amount as a sale and increases their output VAT at the same time as giving themselves a credit for the input VAT. So the overall effect is nil. Basically, you're charging yourself, so self-accounting, charging yourself the VAT and giving yourself the VAT credit input at the same time. Now, how do we do this on a computerized system? One of the VAT rates, and we looked at them last week, one of the VAT rates will show you, I think it's T8 and T4 for sales and purchases from the EU, and the computer will automatically do that for you. Okay, it will give you that credit and it will charge you the VAT at the same time. And this one here is the complicated one for you. It's making sure that you are charging yourself and giving yourself the credit under the same VAT return, so that the effect is nil, but that the numbers are still right. It still shows the right amount of VAT coming in and going out of your business. Okay, option 3, goods leaving Ireland to a non-EU country. So you charge VAT at 0 rate and you keep the proof that the goods left the EU. Okay, so you charge VAT at 0 and you keep the proof that the goods left the EU. Hold on now 1 second. Oh, I went the wrong direction there. And finally then, goods coming into Ireland from non-EU countries. Well, the Irish VAT is charged at the point of entry on the total cost, including all taxes and duties and everything like that, to get it to that point, the point of entry. And you'll have a document then that will show the VAT, and you enter the information in the same usual way that you would into your system, be that a computerized system or a manual system. Okay, so you would treat it like a VAT invoice, that piece that you get from customs showing the VAT. Now, again, a little bit more complicated is this whole idea of international trade when it is services. So all of these things that we've looked at, we've options 1, 2, 3 and 4 were all to do with goods. So selling from Ireland to Europe, buying from Europe into Ireland, selling out of the EU entirely, and buying from non-EU countries. We looked at that with regard to goods. Now, when we talk about services, this is a little bit different, and you've got to think of the place of supply. Okay, so to decide the VAT rate for a service, you've got to figure out what is the place of supply. And under VAT rules, if it's business to business, the place of supply is where the customer is based. And if it's business to customer, the place of supply is where the supplier is based. Okay, so business to business, you look at where is the customer, which of these businesses was the customer, and the place of supply is deemed to be where that customer is. Okay, and then business to customer, the place of supply is where the supplier is based. And based on that, then you would look and you would say, okay, I go back to my 4 rules about goods and I look at which one of these. Is it goods coming into the country? Is it goods going out of the country? Is it outside the EU entirely coming in or going out? And you would apply exactly those rules based on the whole idea of supply. Once you've decided what the place of supply is, use the same 4 rules as for goods above. And again, that's something that may never affect you. You may never be getting services from the EU, but if you do, drop me a line and we'll consider what that specific circumstance is. But with services, you have to decide on the place of supply, and then you would apply those 4 rules that we saw above. Business to business, the place of supply is where the customer is based. Okay, so even let's say if you were getting accounting services and it was business to business and your accountant was in Germany, well then the place of supply would be seen as being in Ireland. okay, because it's business to business. So once the place of supply is decided, you apply those same 4 rules. Again, I'm going to remind you that VAT is a really complicated topic, but once you identify the VAT circumstances within your business, then most, not all obviously, but most of the processing for VAT is simply about repetition. Once you know what you're doing and you've decided what VAT rates apply within your business.